All right. How are you? I hope you had a good day. Yes, today we want to talk about value added tax, which is VAT. So let me just take you through this quickly to be a brush. So basically, before I go into the details, you may need to be aware that value added tax is an indirect tax, which means it is not loud, it is not felt. Yeah, the people who on whom the tax is levied have the discretion to transfer the tax. You know about tax incidents. Yeah, so they can transfer it to the end payers who are going to bear the liabilities. So it doesn't directly fall on them because they have the ability to transfer the tax to the consumers. Value added, so which means there's some value which must be added, just like the name suggests. So if you people talk about value addition and such like things, and this is where VAT comes in, because in most transactions there's value added. Yeah, so if there's value added, then you need to pay tax. And sometimes value is just even locational. You know, in economics there's utility. So if I buy bread and sell to you, I may not add value to that bread, but even the locational advantages, you know, that is value in itself, because you have gotten value, an extra value, because of the fact that I gave you the good and you didn't go to the factory. So value is not just about value addition that we talk about in agriculture or in industry. Yeah, value is loosely translated when it comes to tax. It isn't just productional, but it is kind of broad and encompasses very many things. So value added tax, so the rate is 16%. That one we know. Let me broaden this. The rate of tax is 16%. Now we need to know that this tax, uh, you 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 are eligible to be registered for VAT if your annual income is not less than 5 million. So if a small trader and your annual income is, let me say, 1,500,000, no, that one you may fall under turnover tax. So for value added tax, you have to transact 5 million in sales per year. Yeah, so it's something that you collect, like like um, like you collect the VAT tax from the people that you charge, and then you remit the same to Kenya Revenue Authority. So you're like the go-between. If you're a trader, you're like the go-between the person who pays the tax and KRA. Yeah. So the trader is an agent, let me say like that, who collects VAT on behalf of KRA and then remits to KRA. So, but there's a provision that if your transactions are less than 5 million, then you can apply for voluntary registration. So there's an element of voluntary registration when if your threshold is less than 5M. So VAT is charged on taxable supply by a registered person in Kenya. So those are the guys who transact more than 5M. Those are the guys who have been registered under voluntary registration. But apart from that, VAT is paid on importation, this part B, importation of taxable goods and services. Yeah, so apart from taxable supply, when you import, you also pay VAT. Now you might be wondering, because importation is not really supply, it is counterintuitive if you look at it. Because when you import something, then actually you're not the one who has supplied. Why should you pay VAT? But this is just a special provision. If you're importing a vehicle, if you're importing electronics, if you're importing agricultural item, food, whatever, you have to pay VAT on those goods, except if all of your transactions are vatable. So let me illustrate that in a moment. Let me stop sharing this, then I'll go and share my Excel screen. Just a minute. Window. Where is Excel? Okay, Excel is here. So if you can see it, let me expand this. So VAT is chargeable. So VAT is chargeable. Number one, on taxable supplies. Taxable supplies. Then on number two is importation. Now this importation, taxable supplies you understand, but importation is also has a provision. If you are importing stuff that are completely vatable, yeah. So if you are importing items that you are going to pay VAT on again, then you don't need to pay VAT at the port. Yeah. So let me say you deal with the electronics and you import electronics from China. Now, so let me say you have electronics, let me say 500,000, and you have other non-VAT, let's say 200,000. Now, in this case, you are supposed to pay VAT. So if electronics is vatable, yeah. So on importation, you need to pay you need to pay VAT on this element here, on this 200,000. But if all that you are importing is vatable, which means you are going to charge VAT when you are selling the stuff again, then you will not pay this import tax. It's called reverse tax. So this import tax is called reverse tax. So this is called reverse tax. So reverse tax is not applicable. So not applicable if all items are vatable. Yeah, because I think the government sees that they're still going to collect VAT on these items that you have imported. So if they're going to collect VAT when you are selling, then there's no point of charging you VAT when you are importing. But if the government is not going to collect VAT because the good is non-vatable, then they would want some money from the stuff you are importing. And so they'll charge you VAT on the stuff that you are importing. So I want you to get that distinction very clearly. If items are vatable, no import. No VAT, no reverse tax VAT or import VAT. But if the items are non-vatable, then the government knows that there's no point they will get money from the goods because you'll never charge VAT. So they take VAT at that point. Yeah, so that's why non-vatables are subject to reverse tax, but vatables are not subject. So I want to get that distinction very clearly. And now let's go back to what we were discussing. We were brushing through this. So let me present again. Share screen, share, yes. And then when you come here now, Then monthly returns have to be made. If somebody is not a resident, then somebody has to appoint a tax representative. So if somebody is not a resident, maybe he comes here regularly, then you have to appoint a tax representative who's going to be keeping your books and submitting the returns to Kenya Revenue Authority. Now, there are many categories of supplies in Kenya. We have zero rated, exempt, and standard rate. So zero rated, as the name suggests, the zero rate. Exempt are non-vatable, things that are not subject to VAT, medical, and certain agricultural supplies. Now, the remainder of items is 16% standard rate. It's called standard rate. Yeah, so of course the administration is like VAT is charged per month. Yeah, it's not like income tax for companies, which is subject to installment tax. Of course, we have corporation, but they pay it in installment. But with VAT, it is monthly. It is monthly. Yeah. So that is how it works. So what is a tax point? At what point should you account for tax? So I want you to distinguish tax point and tax payment. Tax point is the point that you account for VAT. Tax payment is the point that you pay for VAT. So by payment, which means you record, by point, tax point accounting, which means you record it as something that you are liable, that you have an obligation that you will eventually pay. So you account for VAT earlier than the time that you pay for VAT. So the tax point is the point that you account for VAT. All right, so what is the tax point then? So as you can see, the tax point is the earlier of date that the supply is delivered, date the invoice is issued, date a certificate is issued for construction services, and then the payment is received. So if you are delivering cement to Baraton and you are Bamburi, Kenya, at what point will you account for the VAT? Either the earlier between the point that you delivered the cement, the point that you invoiced for the cement, or the point that you paid for the cement. So those are three things. So whichever is earlier, you're going to account for it at that time. Yeah, so accounting is very important because of the deadline in payment for VAT. Yeah, because if something has been accounted for, the payment for VAT is 20th of every month. So by 21st, a new VAT period has started. So if 21st of March, you account for something, then you should be paid by the 20th of the following month. Yeah, but if you account for something after 20th, then it will have to shift again. So that's why accounting is important. And like I said, keep this at your fingertips. Tax point is accounting, which is different from tax payment. All right. So the taxable value, of course, that is the consideration of the supply. So consideration is just what you pay for the supply. Yeah. If I'm buying a vehicle, then the amount that I pay to Toyota Kenya is the consideration. It is a monetary sacrifice. But there are certain times that the amount I pay is not allowed. But sometimes I may pay a ridiculously low amount, which may imply that there's some relationship between me and the buyer. While transactions should be carried out at arm's length, which means there should be no closeness. It should be at a distance, which means somebody should charge you the market rates. But if he's so close to you, he's not at an arm's length, and therefore the consideration will not be what will be captured in the market price. So if the consideration is low or far much ridiculous than the market price, then the open market value of the supply will be taken. So this one happens when the supplier and the recipient are related. So in computing the taxable value, the following shall be excluded. So you not exclude interest and card for late payment and all those kind of things. Now the following supplies shall be prohibited for input VAT. So input VAT is the VAT that you pay. Like if I'm a bakery, if I have a bakery, and so I make bread. So the wheat that I buy, I will be paying VAT on that wheat. Yeah, that is what is called input VAT. Output VAT is now the VAT that I charge on the bread. So input VAT is a VAT for for the raw materials or for what I buy, but output is VAT for what goes out. Just like the name suggests. In what gets in. So VAT regime stipulates that I should claim what I paid. But again, I should pay what I charged. Yeah, so the difference that I will actually pay is the difference between output VAT and input VAT, which means what I will pay to Kenya Revenue Authority will be the VAT that I charge the customers set off against the VAT that I paid when I was buying the raw materials or the input from a supplier. Yeah, so let me just explain this through Excel. So let me stop sharing there. Then I go here. Then I present here a window. It will be like this. Now, let me just remove this. Now, what I mean is this. Let me say this is Unga Limited. Unga Limited is buying wheat from company X. So wheat or maize, from a cereals company. So wheat or maize. So wheat or maize will be the input. And the tax that I will pay on the wheat will be the VAT input tax. The VAT that I will pay on this wheat will be the VAT input tax. So wheat is the input tax. When you come to output tax, that will be on this side. So let me just remove this and place it here. This is input tax, which will be on wheat, and the output tax will be on the bread. Let me say the bread or the unga. Let me even call this maize. I think maize is better. And then this is the flour, maize flour. Maize flour. So what happens is maize flour that I supply to retail shops, I will charge output tax. So let me give you an example. Suppose Unga Limited pays 100,000 for the maize, yeah, and sells the maize at 200,000. So how will you account for this? So Unga buys maize before VAT, at 100K. And Unga sells maize flour maize flour at 200k before VAT. So how will you account for this? So the maize that we buy, that Unga buys, the input tax. So this is VAT account. Let me call this VAT ledger. So this is VAT ledger. So let me merge text and wrap. Sorry for that. Yeah, so this one will be VAT ledger. So VAT ledger. This one coming very nicely, but it's okay. So this is the VAT ledger. Then this is the debit side. Let me call this debit side. This is the credit side. Credit side. So what will happen here is that this maize there will be 16% of 100,000, which is 0.16 times 100, 123, will be 16,000. And the video that I will charge my customers will be 16%, 16% times 200,000. So the VAT that I will charge my clients is 32,000, and VAT that I will pay my suppliers is 16,000. Now the VAT that I will pay to Kenya Revenue Authority will be the difference. So VAT output, output will be 32,000. VAT input, will be 16,000. So VAT payable will be the difference, which is 32,000 minus 16,000, which comes to 16,000. So this is the amount that I will pay to Kenya Revenue Authority. So when it comes to here, what I will do, I will debit my VAT ledger. I will debit my VAT ledger and say VAT payable. VAT payable now will be VAT payable will be 16,000. 16,000. Sorry, my VAT payable will be 16,000. And so the debit side and the credit side will balance. So this one is 32,000, and it will also be 32,000. Now, if you look at this, then this ledger is fine. Now, which means the journal here, the journal is to debit VAT ledger with the VAT that you should pay to balance off the VAT ledger, and then you will credit either cash if you're paying it immediately, or VAT payable if you'll pay it later on. Yeah, so that is how input and output VAT works. So let me go back to my document again. So that is what I meant by where in a period input VAT exceeds. Okay. So let me explain this. Number one, the normal way is that a person will have high output tax and less input tax, and therefore he will be in a payable situation. But once in a while, It is not like that. So let me show you this. So what happens sometimes is that, so sometimes input tax is higher than output tax. Yeah, so if input tax is higher than output tax, then a trader or a business should not pay any tax. Yeah, actually, he should claim tax from Kenya Revenue Authority. Yeah, like let me say if VAT output, so if VAT output is 42,000, for instance, 42,000. This is an example. Don't want you to get hung up on it and start asking me where did I arrive with 42,000. Let me say VAT input is 18,000. Then let me say is 50,000. Because this one, so VAT payable will be negative 8,000. So what this one means is that I should not pay VAT. Instead, Kenya Revenue Authority should pay me. But Kenya Revenue Authority is not very excited about paying people. So what they will advise is that if you're in this situation where input tax is more than output tax, then you bid your time. So this is January. And wait for February and set off the excess against February. So if you are, if your transactions for February are something like, let me say 30,000, this is 10,000, 10,000. Again, I'm saying this is an example, and then assume VAT payable. Now VAT payable February is 20,000 because it is output minus input, so that one will be 20,000. But you will not pay this VAT. You will set off January, set off January balance. That so you will set off 8,000, and so you will have net VAT payable, of 12,000 and not 20,000 as was indicated. So this is what happens when you get into a situation where input tax is more than the output tax. Now you would want to know what, let me explain what zero rated and exempt is. Zero rated because this is standard rate that I've been telling you about, and exempt, VAT exempt, So there are items which are VAT exempt, there are traders which are VAT exempt. The businesses which are VAT exempt, like if you are doing less than 5 million, then you are not expected to be a VATable trader. So there are zero rated items also in the VAT exempt items. So VAT exempt are items that don't attract VAT. So VAT exempt items don't attract VAT. Do not attract any VAT. While the zero rated attract VAT at 0%. Attract VAT at 0%. 0%. So if you look at this, you may think that these are similar things. I mean, what is the difference between an item which does not attract any VAT and an item on which VAT is 0? You may just be thinking that we're just playing with words, but the difference is huge. The difference is huge, and the difference is this. The difference is that traders, those who trade, is that those who trade, those who trade in zero supplies, in zero rated supplies, can claim input VAT, input VAT. Yeah. So those who trade in zero rated supplies can claim input VAT, but those who trade in exempt supplies cannot claim. But those who trade in exempt supplies cannot claim input VAT. Input VAT. Yeah, so this is huge because assuming that, so let me give you an example. Assuming that you are dealing with the exempt items. Exempt items. So these exempt items, you pay input tax on them because when you are buying stuff, maybe the person who supplies you is a vertible trader and he will charge you on the items that you are buying. So let me say you pay 160,000 input tax, but you are trading in exempt items. Trader in exempt items. So this is trader in exempt items. On the other hand, this trader uh, is let me say not expected to pay, you know, VAT, or if expected to pay VAT, then he cannot claim. So let me assume that 200,000 is output tax. Yeah. So if you are a vertible person but you're trading in the VAT exempt items, then in this case VAT payable will be 200,000. Okay, the whole amount will be payable. While if you are a trader in zero rated items, this is a trader in zero rated items. This is zero rated items. Zero rated items. Then this is the difference that will take place. Assuming that the details are still the same, and what we'll have here is that VAT payable now will be 40,000. VAT payable will be 40,000 because why? You'll be claiming input tax on the output tax that you pay. So that is why it is far much better to be zero rated than to be exempt. That's why last year when the president was making some tax adjustments and some medical supplies, that he changed from being zero rated to exempt. And what people did not realize that one was a very huge blunder because it would have, made the cost of dealing in those items very exorbitant, and the prices would definitely have gone up. Because if you're dealing with the exempt, you can't claim, but you're dealing with zero rated. So if you're a business, you'd always want to be zero rated. Yeah. Yeah. So, but there's something that I've not indicated here. If you are zero rated, yeah. I think this is fine. I think this is fine. No. This is this is not fine, assuming that you are dealing exclusively in zero-rated items. Then it means that you are not going to pay tax on the item. So your output tax is zero. Your output tax is nil. Okay. Your output tax. By the way, even this one, even exempt items, when you are selling, yeah, when you are selling an exempt item, the VAT payable, here is zero. VAT payable here is nil. Sorry for that confusion. But when you are, so you not pay any tax because the item is VAT exempt. But if the item is zero rated, then you can claim the input tax that you paid for these items. So you will claim 160,000. 160,000. This is still the difference. The mistake that I made was to put tax here for exempt items and tax here. But there will be input tax, because assuming that you are buying raw materials, and these raw materials, you make something that now is zero rated. So you can claim raw materials on the items that you bought. It's quite, it may look complicated, but it is quite simple. It's like assume that you're making a motor vehicle, and motor vehicle parts are vatable, but a motor vehicle is zero rated. So let me say this is a vehicle, but what you're buying here is parts. So if you're buying parts, then the guy who is selling you parts will charge you VAT. But when you've made a vehicle now and you want to sell this vehicle, assuming that the vehicle is zero rated, this is an example again, then you will not charge any VAT on this vehicle. But at the same time, you can claim what you paid for the parts. But here, again, let me use the same analogy, parts, and then this is vehicle. So if vehicle is exempt, then you will not pay tax. At the same time, you will not claim the input tax that you paid for the parts. That is the difference. I want you to get that very clearly. Now, another thing I want to show you is what happens when you're supplying both vatable and exempt items. So let me say that your sales consists of this. Vatable sales is, let me say, 300,000. And then exempt sales is 200,000. And your input cost is 100,000 or 150,000. What will happen here is that, assuming all these are at standard rate, then the VAT on this will be 16%. So this will be 16% times 300,000. This is the VAT that we're going to add here. Exempt sale, there's no VAT because it is exempt. While input the VAT that you pay on your inputs will be 24,000. So how much VAT can you claim? How much input VAT can you claim? So how much input VAT can you claim? Can you claim? So this one will be, so somebody who doesn't know will think that it is 48,000 minus 24, which is 24,000. But if it will not be, it will not be like this. What will happen is that you will have the proportion of sales. So it will be prorated. It will be variable sales divided by total sales times input VAT. So in this case, it will be 300,000 to be 300,000. Let me remove the comma. Divide by, total sales is 500,000. 500,000 times VAT, which is 24,000. 24,000. So this is the formula. So you will claim 14,400. The reason is that you cannot claim the whole of input tax, and yet some things that you made from this input tax, you didn't charge VAT on them. And so it would be unfair to claim the whole, yet the whole will not subject to VAT. So the law is trying to approximate the value of the inputs that were chargeable to VAT, so that you only benefit to the extent that you made chargeable supplies, VAT chargeable supplies. So you cannot benefit the whole extent if you didn't make the whole of it chargeable or VAT subject. So that's why there's some kind of proportionality to find out some fairness in what amount of VAT that you can claim. Yeah, so that is something to do with when supplying both vatable and exempt supplies. So let me again go to my screen and see if I can wind it up now. So what happens, let me go to my notes. Like I said, let me start here. Where my cursor is. Where in a period input VAT exceeds output VAT, the excess shall be carried forward. That one we have talked about. Where the excess input VAT arises from making zero-rated supplies, the excess shall, upon application in a prescribed form, be refunded to the taxpayer. Yeah, so this one I didn't discuss. So basically, if the excess is due to zero-rated supplies, then you can be refunded. But if the excess is just because of the fact that normal standard input tax is more than standard output tax, then you're expected to, to bid your time and claim in the next period. But if it's due to making zero-rated supplies, then in that case, then you can claim. Then where supplies have a mix of both taxable and exempt supplies, the input VAT shall be apportioned to reflect the amount attributable to taxable supplies. And that is what I've just discussed, the concept of apportioning when the VAT supplies are mixed. And then VAT returns should be done by 20th of every month via iTax. And then where taxpayer is unable to file, there should be an application before that time. Yeah, and the records in VAT should be kept for up to 5 years. So I think that is it with the VAT. That is it with the VAT in a nutshell. What you need to know is you need to grasp what is input VAT, what is output VAT, how is output VAT calculated, how much VAT should I pay, assuming that I'm dealing with the reverse VAT, that is import VAT paid on import. When should I pay? At what time am I exempted? So those are the kind of things that you're going to deal with. So let me just list them down here so that we end it here. So the expected learning outcomes, you should be able to know. So this expected learning outcomes. So you should be able to know what VAT is. This is knowledge of theoretical knowledge of VAT as an indirect tax. Tax. Then what else? What are chargeable? Chargeable items. VAT chargeable items. VAT chargeable items. So this should be both taxable supplies. Taxable supplies are chargeable items and what? And importation or reverse VAT Yeah, and you should know when reverse VAT is not paid. Yeah. Then another thing that you should know is you should know something like when VAT tax point. VAT tax point. So tax point is a point that you account for the tax. Then you should also know VAT, payable point. Payable point is the 20th of the following month. But tax point depends. The earlier of the time that you deliver, or you invoice, or you pay, or you issue a certificate of contract. So that one is how it works. Then you should be able to know also when refunds are made. When refunds are made. So what qualifies for refunds? What does not qualify for refund? Like we have said, zero rated. When there's zero rated surplus, then you should be refunded. But when it is just normal standard input tax which outweighs standard output tax, then you should bid your time. Yeah. Now the another thing that we've learned about is apportionment. Apportionment. VAT input when there's a mix between VAT exempt and VAT refund. And again, this one I was missing. We should be able to differentiate between VAT exempt and VAT and zero rated VAT and zero rated VAT and zero rated VAT. And so I think this is just it for now, and this is just it for the topic. Thank you, and have a good time in the course. Okay, so let me just stop sharing now and call it a day.